You spent months mastering supply and demand, scored a 5 on AP Economics, and assume you are ready to conquer the world. But that confidence relies entirely on ideal, frictionless markets. When you apply those basic linear models to real-world economic optimization, they reach their analytical limits. You are suddenly dealing with complex, multi-layered variables. If you open a national economics challenge paper or an international Olympiad exam, basic high school supply and demand models struggle to handle the pressure of actual competitive markets. To model reality and survive these exams, you have to replace high school theory with multivariable calculus and dynamic optimization. This diagram shows the exact hierarchy of the global competition arena. In North America, the National Economics Challenge splits the base into David Ricardo and Adam Smith. Above that sits the US AEO, leading to the absolute peak, the IEO, CEO, and Harvard's HIEEC. At those international tiers, the testing format shifts. You face a 235-minute quantitative barrage, financial literacy simulators, and real-time consulting case studies. The path to national gold requires moving beyond the models used in AP Macroeconomics and adopting the mathematics of system-wide equilibria. Standard introductory economics often assumes that raising wages will always increase the amount of labor supplied. Here is a chart showing the mathematical reality of advanced factor markets. Notice what happens when wages cross this critical threshold. The labor supply curve reverses direction and bends backward. This reversal occurs because the income effect is now mathematically overpowering the substitution effect. The same limitation applies to market structures. Advanced Olympiads move past perfect competition and monopoly to focus on oligopoly. To solve these, you need to calculate Cournot quantity setting and Bertrand price settings equilibria. This 3D graph plots reaction curves for firm A and firm B. Under asymmetric costs, competitors differentiate profit with respect to output on the fly. When firm A drops its marginal cost, firm B's reaction function immediately shifts, establishing a new equilibrium point. In this environment, asymmetric cost differentiation provides the only valid method for modeling actual firm behavior under competitive pressure. Let's pause the theoretical models for a moment and test your raw economic intuition regarding foreign exchange markets. Suppose the spot exchange rate for the Canadian dollar against the US dollar is $1.30, and the one-year forward rate is $1.35. Based strictly on these spot and forward rates, which country requires the higher nominal interest rate? If you guessed the US needs higher rates because its currency is appreciating, you fell into an analytical trap that common intuition often sets for test takers. To solve this, you need the covered interest parity framework. This equation maps the relationship between domestic and foreign interest rates and forward and spot exchange rates. Because the US dollar trades at a forward premium, Canadian nominal rates must be higher to balance. The market demands this mechanically. The higher Canadian interest rate prevents risk-free capital arbitrage across the border. Relying on raw financial intuition is a liability in this field. Applying parity frameworks is the only way to avoid the logic that leads to arbitrage failure and exam elimination. In macroeconomics, standard AP courses usually conclude their curriculum with static aggregate demand and aggregate supply models. Olympiads require a transition into the IS-LM framework and neoclassical growth models. The primary tool here is the Solow-Swan model, and its objective is to determine a nation's long-run steady-state output per worker. This chart models the Solow-Swan steady state. It balances 3 core variables: technological progress, determining output per worker, the national savings curve, and capital depreciation along the break-even investment line. The exact point where savings and depreciation intersect determines the steady-state capital per worker. Central banks influence these long-run states by adjusting interest rate corridors and executing open market operations. You must trace the exact transmission channel of those actions, from the initial shift in investment demand directly down into the international balance of payments. This type of macroeconomic analysis maps the dynamic chain reactions of monetary policy on long-run national growth. But quantitative mastery by itself will not secure a podium finish. It is ineffective if you cannot structure and communicate your models during the critical thinking or business case rounds. In these final rounds, teams are forced to rapidly synthesize and defend policy using dense, real-world datasets, like a 40-page IMF Article 4 monetary crisis report. Top teams structure their defense using the Minto Pyramid Principle. This is a strict, hypothesis-driven framework. In this arena, you avoid chronological storytelling. You must use an answer-first methodology, stating your core policy intervention up front and supporting it downwards with your empirical data. To build both the mathematical precision and this communication skill set, you need a 12-week execution strategy. Phase 1 covers weeks 1 through 4. You will build baseline theoretical fluency using main Q and core econ. Phase 2 spans weeks 5 through 8. Here, you integrate calculus optimization, duopoly reaction curves, and exchange rate parities. Phase 3 takes up weeks 9 and 10. You focus entirely on mastering corporate financial analytics, bond yield discounting, and NPV decision rules. Phase 4 is your final 2 weeks. You execute timed past paper drills under negative marking pressure and deliver mock presentations. The most difficult barrier in this timeline is often the Phase 2 integration of game theory. Click the video on screen now to master non-cooperative payoff matrices, and I will see you there.